Well, here we are again, watching the Federal Reserve scramble to manage an economy that's been slowly imploding for years. And on September 18th, they cut interest rates by 50 basis points for the first time since 2020. 20. But don't get too excited. This isn't a fix. It's more like slapping a Band-Aid on a gaping wound. You see, the Fed has a long history of using rate cuts to stimulate the economy, but this time it feels more like they're buying time. The Fed is slashing rates while juggling an economy weighed down by $35 trillion in debt. Let that number sink in for a second. $35 trillion. It's almost like they've shifted their focus entirely. Forget price stability or employment. Their new mandate seems to be all about keeping the government from defaulting on its loans. They're just trying to keep the debt service sustainable for as long as possible. But how did we get here? Simple. The Fed has been cutting rates and flooding the system with cheap money every time there was the faintest whiff of a recession. Instead of letting the economy reset naturally, they pumped it full of cash, created bubbles, and fueled reckless government spending. And here we are, dealing with the consequences, full-time jobs. We've lost 1 million in the last year. I thought, and don't be fooled by the employment headlines. They're mostly padded with government jobs. The private sector is another story altogether. It's shrinking, shedding nearly 500,000 jobs, while the government swells by 700,000. And yet, the Fed's rate cuts keep coming. Their solution? Make borrowing cheaper and hope no one notices the cracks in the foundation. And it gets worse. Those rate cuts aren't just affecting jobs, they're wreaking havoc in the banking sector too. Many banks are sitting on mountains of unrealized losses thanks to the Fed's earlier rate hikes, which tanked the value of their so-called safe assets. These banks are doing their best to hide the mess, but let's face it, it's only a matter of time before more banks follow in the footsteps of Silicon Valley Bank and Signature Bank. Now, let's talk politics. The corporate Democrats are playing a dangerous game. They're trying to delay the inevitable economic fallout by pumping up government jobs and pushing fiscal spending through the roof, hoping they can hold everything together until after the next election. But if Trump wins, you can bet that stagflation bomb they've been sitting on is going to explode right in his lap. So what's the Fed supposed to do? Lower rates further to save the banks and watch inflation spiral out of control? Or keep rates high to fight inflation while pushing both the banks and the private sector deeper into crisis? It's a lose-lose scenario, and we're all along for the ride. When you spend decades kicking the can down the road, eventually you run out of road, and that's where we are now, at the end of the road. The Fed's rate cuts, reckless fiscal policy, and an ever-growing debt burden have left us teetering on the edge of an economic collapse. The debt, the job losses, the inflation, it's all coming to a head. This isn't just another economic downturn. This is the result of years of bad decisions catching up with us. So where does that leave us? In a classic stagflation nightmare. High prices, fewer jobs, and an economy that's barely limping along. The Fed can't fix this mess, and when the reality finally hits, it won't just be the banks or the Fed that suffer. It'll be everyone.
Middle MAGA.